Okay, let's talk about the taxation of capital assets. Much of this is review, which is nice, but there's also some really crucial new material in here for financial planners. So here's our lecture overview. Now, the taxation of capital assets is our topic, so let's double check that we know specifically what capital assets are. We defined it briefly in a prior lecture, but we have these three asset categories: ordinary income assets, Section 1231 assets, and capital assets. Now notice that ordinary income assets are assets that generate ordinary income. Section 1231 assets are depreciable or real property held for the productive use in a trade or business, and capital assets are everything else. So capital assets are really defined in the negative. Now, examples of capital assets are securities, collectibles, personal assets, and intangible investment assets. So the book's got this nice acronym here for asset categorization. All assets are capital assets except these four things with this asset acronym right here. So stop and read that. Make sure you can absorb that. Okay, examples of capital assets. One thing are collectibles. Another thing, your personal home is actually a capital asset. Stocks and bonds are a capital asset. And are capital assets depreciable? We've recently discussed depreciation. Now here's what depreciable assets are. Tangible assets, meaning you can touch them, held for productive use in a trade or business or held for the production of income. So your home, stocks and bonds, we said are examples. Collectibles are in this category, but none of these are depreciable. They're not in a trade or business. They're not included in a trade or business. Now, these things are not capital assets. These are Section 1231 assets, or down here at the bottom in the case of inventory, that's ordinary income asset. Okay, and again, just a quick review. Why does the type of asset matter? Because the tax treatment is different. So let's look in the capital asset column because that's what we're discussing here. If you sell capital assets for a gain, you get capital gain treatment. If you sell it for a loss, you have capital loss treatment. All right, so we'll discuss, of course, exactly what that is in a little more depth. Okay, realization and recognition. We've talked about the realization of income. For example, you sell the stock, so now you have actually realized the gain. You've got the money for it. Recognition means you put it on the tax return. Now, personal losses are not generally deductible. In other words, we don't recognize personal losses. So, example, you've got your personal residence, and we've gone over this before. Luke buys a primary residence for $300,000. This is his cost basis in the property. He sells it 5 years later for $250,000. Ouch. This $50,000 loss is painful enough, but now he can't even deduct it on his tax return. It's a realized loss, but not a recognized loss. And that hurts. Okay, another example, you go to Antiques Roadshow and you find out the statue you bought for 50 cents at a garage sale is worth $50,000. Yay! Okay, personal losses are not deductible, but personal gains are taxable. Okay, but again, this is a capital asset, so it will be taxed at capital gains rates. Another example here is conversion of primary residence to rental property. Okay, Nissa buys a primary residence for $400,000, so this is a capital asset. This is her cost basis in the property. She would like to sell it 3 years later, but it's only worth $250,000. The $150,000 loss cannot be recognized or deducted, cannot be put on her tax return. So again, personal losses, even a capital assets, are not deductible. So uh, a lot of people say, well, okay, so I'm going to convert my primary residence into rental. This doesn't have to be because you're in a loss position, but often it is. So Nissa decides to convert the home to a rental property instead of selling it. Now, will this allow her to take a loss in the home because the home is now investment property? She bought the home for $400,000. At the time of conversion, the fair market value was $250,000. As a rental property, the basis becomes the lesser of the taxpayer's basis in the property or the fair market value. So in this situation, the fair market value of $250,000 is going to be the new basis, unfortunately. So Nissa later sells the rental home for $230,000. The market keeps going down. So what loss can she take? She sold it for $230,000. She has a basis of $250,000. Now she has a deductible loss of $20,000. The $20,000 will be a recognized loss on this investment property. Her total loss was really $170,000, $400,000 minus $230,000. But converting to a rental does not allow a person to take a loss on the formerly personal asset portion of the loss, but losses after conversion can be deducted as a loss. This loss of $20,000 is a loss on investment, not a personal loss. Okay, so even with personal capital assets, losses cannot be recognized or deducted. However, investment losses are generally deductible, and of course, investment gains are taxable. Okay, another thing we need to clarify here is just a review of wash sales. Now, you can hold capital assets, but if you have a wash sale on the capital asset, you can the loss will be disallowed. In other words, not recognized. So we're going to just review this quickly. Zach buys 100 shares of XYZ for $2,000 in year 1. At the end of year 3, the shares are worth $500. Well, he'd like to sell them and show a $1,500 loss in his tax return in year 3 in order to reduce his taxes. But his problem is that he believes XYZ may increase in value, so he actually wants to continue to hold the shares. He doesn't want to sell them and get rid of them. So what he does is he sells the shares for a loss, and then he repurchases the 100 shares for the market price of $500 30 days later. So what he's done is engage in a wash sale. A wash sale is a sale at a loss and a repurchase of substantially identical securities within 30 days before or after the sale. This is a sale at a loss, not a gain. And of course, as you recall, the problem with wash sales is you can't deduct the loss. Now he's in substantially the same position he was before, so the loss is disallowed. But the disallowed loss is added to the basis. So his basis of the new shares will be $2,000. Now, we asked the question when we went over wash sales in an earlier chapter, as planners, is there a way for clients to take a loss on the return but not really change the portfolio much? Well, sure, because the wash sale definition, it's a sale at a loss and repurchase of substantially identical securities within 30 days before or after the sale. So what you could buy exactly the same, or you could buy substantially identical securities within 31 days before or 31 days after the sale. Or if you're in with this 60-day window still, you can buy similar securities but not substantially identical securities, and we went over what that is in an earlier chapter. Okay, asset holding periods and tax rates. So again, this is something we've had before. So if you want a long-term capital gain or loss, the holding period is greater than a year. So we've been saying a year and a day to get long-term capital gain treatment. Short-term capital gains occur if you sell within a year. So they're still capital gains, but they are short-term capital gains, and these short-term capital gains are taxed at ordinary rates. So here again is the ordinary income tax rates, and we've looked at those before, and we saw that they were much higher than these long-term capital rates, and so these capital gains rates are based on taxable income. And so you can see that the tax rates are much, much lower than on ordinary income. So long-term capital gains get taxed at a much lower rate. So income tax planning principle, take advantage of long-term capital gains rates. For gains, be sure to hold the capital assets long-term to use the favorable long-term capital gains rate. So, if you have taxable income from wages of $150,000, taxable income from long-term capital gains of $75,000, you have total taxable income of $225,000. your wages, they're going to be taxed at ordinary rates, but that long-term capital gain will be taxed at capital gains rates. So hold those stocks for more than a year. Okay, the bad news is that there's a limit on the deduction of net capital losses, not gains, of course. So a net capital gains are fully recognized. Johnny Money sold stock and had a $3 million net capital gain in year one. All of that gain is going to be included in income in year one. Now, we've talked about capital gains, but now this is the first time we've introduced this idea of a net capital gain. So we'll talk about this here. But net capital losses, as we indicated, are limited. Okay, so Porky Pig sold stock and he had $1 million net capital loss in year one. Only $3,000 can be deducted. That is the loss limit on capital losses. Now, you don't just lose the rest of that capital loss. The remainder of the loss is carried forward to future years. So of this $1 million net capital loss, he could deduct only $3,000 of it a year. So he's not even going to live long enough to even get a tax benefit from that whole loss, most likely. But the remainder is carried forward to future years. Now, unused losses retain their character as to short or long term, and they're carried forward indefinitely. So we'll talk more about what that really means here in a moment. So $3,000 capital loss, that's all. All right, net capital gains and losses. Now we're going to determine the net capital gain or loss. Capital gains and losses must be netted by holding period. First, short-term capital gains and losses are netted together. Then, 2, long-term capital gains and losses are netted. 3, if both are gains or both are losses, the netting process stops. So you're done netting. Number 4, if one is a net gain and the other is a loss, however, then the long-term gains or losses are netted with short-term gains or losses. We'll, of course, go over examples of this. Number 5, net gains, as we said, are fully taxable. Number 6, if there is a net loss, only $3,000 is deductible in that year. 7, the short-term losses are used up first. In other words, if you've got some long-term losses and some short-term losses and you're limited to $3,000, what do you put on your return? Well, you put the short-term losses first and then you put the long-term losses if you have any of that $3,000 remaining. Number 8, any remaining unused loss is carried forward to future tax years indefinitely. And 9, losses retain their character when carried forward. They're either still short-term or long-term. Losses. Okay, so here's just a bunch of examples. So here we have someone with both short-term and long-term sales. First, we're going to net the short-term sales gains and losses. And so here this person has a net short-term capital gain of $2,000. Next, we're going to net the long-term gains and losses together. So here this person has a $1,000 net long-term capital gain. Now, no further netting is necessary because both are gains. So the netting process stops. Now we know that gains are included in income. And so the taxable income of this person is increased by $3,000, $2,000 from the net short-term capital gain, $1,000 from the net long-term capital gain. Now the $2,000 net short-term capital gain is going to be taxed at ordinary rates, and the $1,000 net long-term capital gain is taxed at capital gains rate, of course, the favorable rate. Okay, so net gains are fully taxable. Now we have a situation, again, we have some short-term and long-term sales. Here we've got a short-term net capital loss and a net long-term capital loss. So again, no further netting is necessary because both are losses. The short-term losses are deducted first, and so as we know, $3,000 is currently deductible. So step 6, short-term losses are deducted first. The income taxed at ordinary rates is reduced due to the deduction. So we have a net short-term capital loss of $5,000. You're going to take $3,000 of that loss on the return. That leaves $2,000 of net short-term capital loss carryover and the $2,000 net long-term capital loss carryover. We didn't even get to touch the long-term capital loss in this year. And losses carried forward retain their character. So we're going to keep track of whether they're short-term or long-term losses. Okay, here we've got again a net short-term capital gain of $5,000, a net long-term capital loss of $2,000. Now, these are of different signs, and so we're going to continue the netting process since one is a gain and one is a loss. We're going to net them together. And so we've got a net short-term capital gain minus the net long-term capital loss gives us a $3,000 net short-term capital gain. And how do we know that that $3,000 is a net short-term capital gain? Because the bigger one is the one that gives it its character, and the net short-term capital gain is bigger. So we end up with a gain, and so we've got a net short-term capital gain. And so gains are fully taxable. This will be taxed at ordinary rates because it's short-term. Okay, here we've got a net short-term capital loss of $2,000, net long-term capital gain of $7,000. So we're going to net them together. Which one's bigger? The net long-term capital loss. And so we know after we net them, we will have a net long-term capital gain. And so we have a net result here of a net long-term capital gain of $5,000. The gain is taxed at capital gains rates because it's long-term. Okay, here we have $3,000 net short-term capital loss and $1,000 long-term capital gain. So they're different signs. We're going to net them together. Which one is bigger? The net short-term capital loss is bigger. And so we're going to end up with a net short-term capital loss of $2,000 after the netting process. So this reduces taxable income, and it reduces income that's taxed at ordinary rates because it's a short-term loss. Here we've got another example. We've got a net short-term capital loss of $30,000 and a net long-term capital gain of only $1,000. So we're going to net them together. And of course, the net short-term capital loss is larger. So we end up with a net short-term capital loss of $29,000. So it reduces taxable income by only $3,000 this year because capital losses are limited, but the remaining short-term capital loss is going to be carried forward to future years. And one more example here, we have a net short-term capital gain and a net long-term capital loss. The net long-term capital loss is larger, and so when we net these two together, we come up with a net long-term capital loss of $28,000. Now, this again is going to reduce taxable income by only $3,000, and the remaining $25,000 long-term capital loss is carried forward. Okay, another review, net investment income tax. If you recall, this is a 3.8% investment income surtax, and it applies to the lesser of two things. So you have to make two calculations here. You have to add up all the net investment income, or number two, MAGI over a threshold amount. So recall that the MAGI, modified adjusted gross income, is a term you see all through tax. It's adjusted gross income and it's modified, and the modifications depend on the use. So we're not going to worry about exactly what the modifications are, but you're going to take, for our purposes, it's not very important. But you take this MAGI over the threshold amount. For married filing joint, $250, married filing separately, $125, and singles, $200,000. So you do those two calculations, and the lower one is what you apply the 3.8 investment income surtax to. So this is a review, and net investment income includes portfolio income, income from past activities, and gains on disposition of property. That's our capital gains sales there, and other gains, but including capital gains. Okay, so most of this information has been a review. However, there's some profound implications for a portfolio manager on these loss limitations. So, tax should never drive your portfolio allocation, but use the portfolio when possible to use up losses. So here's our example. Marley has $1 million capital loss on worthless stock in excess of that $3,000 limit. Now, with the loss limit, he will never get a tax benefit during his lifetime for most of that loss. The portfolio has $750,000 of unrealized gain. In other words, it's appreciated, but they haven't sold it, right? Unrealized gain. So what you can do here to save your client a lot of money is sell the gain stocks in order to use the loss. So, for example, here we have the $750,000 realized gain if we're going to sell them. So we're going to recognize $750,000. We have $1 million loss, and now the unused loss carryover is down to $250,000. So this is still substantial. In the future, you'd want to do all you can to take more loss, to realize more losses in order to use up this. But what's happened is that you have taken $750,000 of gain into income, and you don't have to pay income taxes on it because it is netted against that $1 million loss. So here Marley can sell the gain stocks without changing his portfolio allocation. He can sell and rebuy the same stocks if he wishes, even on the same day, because the wash sale rules only apply to selling stocks at a loss. The repurchase stocks, if he repurchases even this very same stocks, they'll have a higher basis, and that'll reduce gains in the future when he sells them. So he's been able to shelter $750,000 of gain from taxation. So use that portfolio when possible to use up losses. Don't let it drive the allocation, but you can use up gains and losses very often without changing the portfolio allocation. Okay, another rule. Tax should never drive portfolio allocation, but use the portfolio when possible to shelter gains. So, for example, Barley has a $200,000 of realized capital gains in his portfolio due to portfolio rebalancing. Now, his portfolio also has $150,000 of unrealized losses on stocks that are down, but still desirable to hold. So you should consider selling the lost stocks to shelter the gain. So in this example, we have $200,000 of gain. If we sell those lost stocks, we have $150,000 of loss. And that has lowered the amount of gain that we have to recognize on the tax return down to $50,000. Now here, Marley can sell the lost stocks without changing his portfolio allocation. He can, by rebuying them or buying similar but not substantially identical securities, or he can buy and sell outside of that 60-day window of the wash sale rules. So again, he's been able to shelter $150,000 of gain from taxation by using those gains and losses in his portfolio without changing his portfolio allocation. Now, the timing of losses and gains should be considered when selling capital assets. So you're doing some year-end tax planning for Shelley. Portfolio rebalancing in her case will result in gains that will make her subject to the NIIT. So consider rebalancing in January of the coming year instead of in the current year to postpone tax due. So, income tax planning principles. Control the timing of gross income. Use capital gains to use large capital losses. Use capital losses to shelter large capital gains. And for year-end planning, time gains to reduce and postpone taxes in the NIIT. Tax should not drive portfolio allocation, but use the portfolio to your best advantage.